The recent economic challenges in Africa have significantly disrupted the continent's payment landscape, prompting the withdrawal of several international payment firms, including Mercury. Now, this decision highlights the far-reaching implications of compliance and risk profiling by some international banks, which can inadvertently disadvantage African businesses and the consumer. So to address these challenges, a nuanced approach is essential. This morning, Ibrahim Ibitade, CEO of Leatherback, joins me from London, UK, to help us understand this. Thank you so much for joining us on Business Edge.
Thank you very much for having me. Good morning.
All right, so we understand that Africa has a burgeoning tech ecosystem, but this seems to be threatened by global economic headwinds as we know it, rising interest rates. We're also talking about tightening investment conditions. Now, how would you say these factors are impacting financiers who before now have been forthcoming with support?
I mean, it's a very tight market right now. I mean, investments isn't flowing as much as it used to, and I mean, I think the current situation with startups exiting Africa and the performance of startups generally too, and the basic landscape and the ability of these startups to also make the right kind of impacts that they should has not been as positive as many investors have projected. So it's very essential right now for all startups to get all the kind of help they need to be able to scale and grow further. And this whole Mercury debacle and not even being able to get access to basic bank accounts is something putting a clog in the wheel to allow startups keep moving forward. I mean, the minute you can't get a basic bank account to actually allow you flourish globally, because you find that many African startups today have expansion tendencies and expansion plans. So if you can't expand to get basic bank accounts to be able to function, then you can't even carry out your basic day-to-day activities. So it's not the best situation right now with everything going on.
So for these financiers, for the startup industry, the tech industry, how do you think all these, especially these three variables, can come together to actually synergize in the face of the challenges that you've highlighted in the African continent?
I mean, they are different, but all the different key stakeholders have a role to play. I mean, startups have a role to play, the financiers have a role to play, the government has a role to play in this, the multilateral institutions also have a role to play. You need to create an enabling ecosystem for startups and financial services providers to allow them flourish and offer the right kind of services that are in tune with the growing innovative strides that we're seeing in the markets today. You have many sectors, tons and tons of sectors, from the food delivery sector to the financial services sector to the people that issue cards, to remittance companies, to even AI companies today, AI-driven businesses today. You find tons and tons of businesses with different innovative solutions that there are no proper regulatory provisions or framework to allow them flourish and grow. So it essentially starts from all the necessary people. The financiers need to recognize that as you're providing the finances, you need to be able to support these same startups with the right kind of infrastructure, the right kind of, I mean, as simple as providing basic bank accounts. I mean, Leatherback today has partnered with some VC firms and some investment firms who have startups in their portfolio to make sure that as you're getting funds in, you're able to also get access to Leatherback bank accounts to be able to keep your funds in multiple currencies, Canadian dollars, USD, GBP, Euro, okay. Nigerian Naira, of currencies.
Okay, so let's now tie that to Mercury's decision to also withdraw. Looking at the primary factors and the influence that Mercury has itself within that space, would you say that the reasons are equally valid? And how do you even think that would affect the perception of African markets by international banks?
I mean, personally, I don't think the reasons are valid, personally. But I mean, it's understandable. Different companies make different decisions based on their risk appetite and their risk structure, right? Leatherback, for example, will always align our risk appetite to that of our global banking partners, our global financial services providers. We recognize that different people have different risk appetites. We are structured as a business that has appetite for frontier markets, and i.e. Africa and other developing markets. So you'll find that Mercury Bank, for example, has done their assessment and they've seen that the market is not the most viable for them right now. Maybe the income is not the most viable for them. Maybe the risk is not something that they understand, and they don't see the returns or the value of the returns in them going into now invest a lot of money to understand that market. It doesn't. It's just not something that aligns for them. But considering the fact that, like I always say, Nigeria is a country of over 200 million people, a massive, massive economy, a heavy importing economy. These 200 people must eat, must grow, must sell, must transport. They must carry out basic day-to-day activities. You can't disconnect them from the global from other the global economy basically, and that action is something that can potentially disconnect the country from the global economy. So it's not something I agree with.
That's quite big. Now let's look at the issue around compliance and risk profiling practices by international banks. How do you think this affects African businesses? And of course, if it does, what would you say are the broader implications for the continent with this trend?
I think it's a question of understanding, right? Do we need to understand where Africa is today? International banks, global businesses need to understand where Africa is today. Where we are not, we're in Africa where quite a number of people still pay rent. Even, and when I mean still pay rent, I'm referring to the most basic example that I always typically use is my rent, my proof of address might not be in my name, might be in my landlord's name because I rent a property in Witemeta or something, right? We're in a country where to verify or validate proof of address requires a little bit more. It's not just as easy as you put in your postcode online and it validates and it runs through some credit registry and then you're just able to see that, oh, this person has lived in this place for the past 10 years. No, right? There are processes there's a separate kind of work that needs to be done to understand the concept of properly carrying out effective KYC and KYB practices in Africa. And for us to be able to do that, the businesses and banks, international banks, need to understand this and be committed to actually putting in the work, right? And that's where local businesses today, I will say that you will find that quite a number of financial services providers across Africa, from Leatherback to quite a number of guys out there, are top tier compliant firms that have done a lot of work to make sure they lay down the foundations for what compliance across Africa should look like in the most automated fashion. I think the global and international banks just need to plug into this and understand and see that they can rely on these regulated firms to give them access into the African market.
So, if we're talking about facilitating understanding, we're talking about granting access. What are the specific steps or nuances that you believe that most especially international financial institutions will need to take or probably consider when they're dealing with emerging markets in Africa? Because we're talking about scaling up, we're talking about growing or spreading their horizon, so to speak. But then we still have these inhibitions in place. So, for these international institutions, what do you think their focus or dealings should be to help African markets in this like?
Number one is regulation, right? I mean, you'll find a majority of the biggest and largest financial services providers in Africa are heavily regulated. Leatherback, we're an EMI in the UK, we're PSP in Nigeria, and MSB in Canada, like we're regulated in 7 countries, as far as India, Nepal, even Ethiopia, right? You find that quite a number of many other financial institutions are regulated in tons and tons of countries. I mean, just yesterday, I still saw one of the biggest startups in fintechs in Africa got licensed in, I think, Tanzania or so. Another one got licensed in Egypt. So, the point is, the first thing is regulation. They need to look at the fact that if a company, if a financial services firm has gone the step of making sure that they are regulated in a country, then they have taken the first step in being willing to make sure the proper checks, KYC, KYB, EDD, sanction screening, transaction monitoring processes are done on all their clients. That's the first thing. The second thing is accessibility of data. If you find that the local financial services firms are willing to give you access to the necessary information you need, and there's no reason why you should put a blocker on the transactions. I mean, like I said, it's a massive continent and Nigeria is a massive country. You need to understand. I mean, from the guy in the Dumota market to the guy in Alaba market that is importing heavily containers regularly into Nigeria to just go and sell, being identified with specific vices has not done us any good at all. And it's not a reality. The reality is that we are a trade-based economy and we need to sell. And trade is one of the things that leads us everywhere in Leatherback. So the second thing that needs to be done is if you have financial services firms that are willing to expose their information to you to let you see that we've done the necessary KYC, we've done the necessary ID checks, we've done the necessary PO check, we've done the necessary sanction screen check, and we're telling you that based on this list that you guys have provided to us, right? Which the FATF has provided, which the UN has provided, which the World Bank has provided. This list, we've run different clients on this list, and this is what we have arrived at. These are our conclusions. Based on that, there's no reason why you should not be able to do that, which is where enhanced due diligence comes in, right? And we recognize it, and we're going to do that. So it's necessary for them to look out for those things. And again, also for the little tiny things, right? Financial inclusion is still something that we're struggling to find a way to get to make it prevalent across Africa, across
Okay.
Nigeria.
All right.
Understanding that the guy in one village needs to still receive money from his uncle
Of course.
abroad, and yeah, the information you need to get on that guy. Yeah, so those are basic things that needs to actually be put into consideration.
Definitely, there's a lot of potential in that particular sector, and it would also speak more to the startups and the companies within that space to also see how they can build resilience and be more robust along the value chain while not totally relying on probably the international institutions, probably the financiers to scale up their operations. Thank you so much for sharing your thoughts with us on the show. We appreciate that.